You are watching this because the mainstream financial media will not show you what those numbers actually mean. They will tell you silver sold off on macro pressure. They will tell you the dollar strengthened. They will give you a chart with a red candle and move on to the next story. What they will not tell you is what was happening inside the vaults while that red candle was printing. What they will not tell you is who was standing on the other side of those 531 tons of paper contracts. And what they will not tell you is that this exact sequence, eisberu, this precise fingerprint of paper volume with zero physical movement, eisberu, has appeared twice before in the last 50 years. Both times, it preceded a historic silver repricing, not down, up. But that's not the part that should concern you yet. Right now, at this moment, there are 356 paper claims for every single registered ounce of physical silver sitting in COMEX vaults, 356 to 1. Think about what that number means in plain language. If you have 356 people and only one chair, and someone shouts, "Sit down," 355 people hit the floor. That is not a market. That is a game of musical chairs with one chair and 355 players who don't know the music is about to stop. And here is the anomaly that started this whole investigation for me. The day silver dropped, aroro. And I mean the exact session when the price collapsed, aroro. Physical silver in Tokyo was trading at 130 per ounce. Physical silver in parts of the Gulf was at 106. The paper price on your trading screen, $84. A 44% gap between what a piece of paper said silver was worth and what a buyer in Tokyo was actually willing to pay to hold it in their hands. That gap doesn't exist in a fair market. This number doesn't exist in a fair market. So let me walk you through exactly what happened. And more importantly, I want to show you why what you just watched was not a market event. It was a mechanism. A very specific, very documented mechanism that has been deployed before Eiriru. And every time it has been deployed, the people who understood it came out the other side in a completely different financial position than the people who didn't. Let's start with the COMEX. That's the commodity exchange Eiduro, the primary paper market where most of the world's silver price is set. Not by physical buyers and sellers, by paper contracts, futures. Promises to deliver silver that, in the overwhelming majority of cases, are never actually delivered. COMEX registered silver inventories have dropped 70% since 2020, 70%. In 4 years, the physical backing behind the paper market has been gutted. London's LBMA vaults, wow, the other major custodian, wow, down 40%. Shanghai vaults at decade lows, 3 continents, 3 separate vault systems, all draining simultaneously. So the question you should be asking right now is, if the vaults are draining and demand isn't falling awaro, and we'll get to exactly why demand is not falling awaro, then what is holding the paper price where it is? And the answer to that question is the most important thing I'm going to show you today. But first, awaro. If this is the kind of analysis you've been looking for, the kind the mainstream will not run, subscribe right now. Hit the notification bell. Because what comes next in this series is going to be even more important than what I'm about to show you, and I don't want you to miss it. Subscribe. It takes 3 seconds. It's free. Now, back to that 531-ton number on the day silver was dumped, ARO. And I want you to understand the word dumped is not dramatic. It is technically accurate. AO, 531 tons of silver contracts, changed hands in Shanghai's paper market in a single session. That is not organic selling. That is not retail investors deciding to rotate out of silver and into something else. That is a coordinated offload of paper at a scale that is mechanically designed to move price. When you drop 531 tons of paper contracts into a thin market all at once, the price has nowhere to go but down. That's basic market mechanics. That's not conspiracy, that's math. And here's the part that makes it impossible to explain as normal market activity. 0 tons of physical silver moved from Shanghai vaults on that same day. 0. If this was genuine selling ARR, if real silver holders had looked at the market and decided the price was too high and they wanted out, some of that metal would have moved. Custody transfers happen. Withdrawals happen. Physical delivery happens. In a real market, when 531 tons of metal are sold, some of it moves. Nothing moved. The price crashed. The vaults didn't change. The paper said one thing. The vault said something different. And the gap between those two things is not a rounding error. It is a 44% premium that physical buyers around the world were paying above the paper price on the exact same day. That is not a market. That is a magic trick. Once you understand the ratio, the price action makes sense. And the ratio I'm talking about is not just the 356 to 1 paper to physical leverage at COMEX. It's a ratio that connects 5 major financial institutions, 3 separate decade-level events, and a pattern that has been documented, prosecuted, and fined and then apparently repeated anyway. Let me give you the historical record, because this is not the first time this has happened, and I want to say that clearly. This is not the first time. It is the third. 1980. Silver had run from $6 to $50 euro, a 730% rally in 14 months. Physical demand was surging. Stackers were buying. The Hunt brothers had accumulated an enormous position. And then the CME did something extraordinary. They passed Silver Rule 7 RRO, a rule that limited new silver contracts to liquidation only. You could sell, you could not buy new long positions. In the same window, the Federal Reserve raised interest rates from 11% to 20%. The result? Silver went from $50 to $10 in 8 weeks, an 80% collapse. The people who bought at $40 and $45 thinking the momentum would continue were doers, gone. The institutions that had been short the whole way up were buoys they covered at the bottom. Same playbook, different decade, 2011. Silver ran from 18 to 49, $80 euro, another historic rally. Between April 26th and May 5th of 2011, the CME raised margin requirements 5 times in 9 days. 5 times in 9 days. Every hike forced leveraged longs to either post more capital or liquidate, most liquidated. Silver went from $49 to $26 in less than 2 weeks. It took 13 years Eboro to see those prices again. Now look at what happened going into this most recent crash. CME raised margin requirements 4 times in 6 weeks before the dump. 4 times, then raised again after the collapse, then scheduled additional hikes for the following Monday. If you were designing a mechanism to force paper longs out of the market and allow institutional shorts to cover at favorable prices, this is exactly what that mechanism would look like. But that's not the part that should concern you. Here is the part that should concern you. After the 2008 financial crisis, 5 major banks were investigated, charged, and in several cases convicted for silver market manipulation. JP Morgan racketeering charges, settled. Scotiabank fined. HSBC fined. Deutsche Bank cooperated with regulators. Morgan Stanley settlement. 5 banks, documented on record. And here is what the filing data shows from the most recent event. JP Morgan closed 147 contracts at the exact bottom of the dump. Morgan Stanley closed 31. Deutsche Bank closed 58. HSBC closed 60. These are not coincidences. These are the same institutions using the same playbook at the same point in the cycle, buying at the exact bottom of a move they had a documented interest in creating. Wall Street is not confused. They know exactly what this means. Now let me connect this to a number that nobody on mainstream financial media was discussing the morning after the dump. The premium held through the entire dump. That is the sentence I want you to remember. The physical premium the gap between what you pay for real silver versus what the paper market says it's worth that premium did not disappear when the price dropped. It didn't narrow. It widened. At the paper price of $84, physical dealers in the United States were charging $96 to $100 for 1 ounce silver rounds. In Tokyo, $130. In the Gulf, $106. When a paper price falls and the physical premium rises simultaneously, there is only one explanation that fits the data. Physical buyers don't believe the paper price. They're willing to pay more substantially more to hold the actual metal, because they understand that the paper price is being set by a mechanism that has nothing to do with genuine supply and demand. Here's what they filed at 3 a.m. that nobody is talking about. The COMEX warehouse reports Ezeburo. Those are the filings that show exactly how much registered silver is available for delivery against paper contracts, Ezeburo. Those reports show that in the month preceding the dump, 18 million ounces of silver moved from registered status to eligible status. That distinction matters enormously. Registered silver is available for immediate delivery against futures contracts. Eligible silver is physically present, but not committed for delivery. When metal moves from registered to eligible, it is being quietly withdrawn from the pool that backs the paper market. 18 million ounces pulled back. And then AJWO, right on schedule, AWORO, the paper contracts were sold down hard, margin requirements were raised, and the price broke. The gap didn't close, it widened. Let me now show you the east-west dimension of this story, because this is where the full scale of what is happening becomes undeniable. Shanghai physical silver was trading at $122 on the day. Western screens showed $84. That is not a minor arbitrage. That is a 45% divergence between 2 prices that are supposed to represent the same physical commodity in the same global market. The West is still pricing this like 2019. The East stopped pricing it like 2019 a long time ago. Why does the gap exist? Because Eastern buyers, and we are talking about China, Japan, Southeast Asia, India, the Gulf, are buying physical. They take delivery. They move metal out of the system. When you take delivery, you're converting a paper promise into a real ounce, and you are permanently reducing the registered inventory that supports all the other paper promises. Eastern buyers have been doing this consistently, at scale, for years. Western buyers, by contrast, are overwhelmingly buying paper. ETFs, futures contracts, certificates, things that represent silver without requiring anyone to actually produce it. As long as the West keeps absorbing paper, the paper market can keep setting the price. And as long as the paper market sets the price, the institutions that run that market can periodically reset it downward, cover their short positions, and prepare for the next cycle. But here's what's changed, and this is the structural shift that makes this particular moment different from 2011 and 1980. The 5-year cumulative silver supply deficit is now 820 million ounces. That is roughly 1 full year of total global mine production as consumed, gone, soldered into solar panels and EV batteries and AI chip manufacturing infrastructure, sitting inside the devices that are building the next generation of the global economy. That silver is not coming back. It is not sitting in a vault waiting to be mobilized. It is embedded in physical infrastructure across 4 continents. Mine supply grows at approximately 1% per year. You cannot accelerate that. From discovery to production, a new silver mine takes 10 to 15 years. There is no supply response that arrives in time to matter. Meanwhile, solar panel manufacturing alone is projected to consume 232 million ounces of silver in 2026. The EV industry, another 100 million. AI infrastructure, growing. The demand curve is exponential. The supply curve is flat. And 2026 is expected to be the 6th consecutive deficit year. Why did JP Morgan reclassify 13 million ounces overnight? How can 356 paper claims exist for every real ounce? What happens to your savings when this ratio collapses? These are not rhetorical questions. These are the questions that define whether the money you've put into physical silver and gold survives what's coming or becomes somebody else's exit liquidity. Because here's what they don't tell you. In a market with 356 paper claims per physical ounce, if even 1% of paper holders demand real delivery, the math breaks. At 1%, you need 3. 56 ounces delivered for every ounce available. At 3%, the system cannot function. The moment physical delivery demand exceeds registered inventory, and that moment gets closer every month as vaults drain, the paper price mechanism loses its anchor to reality. The physical price disconnects entirely, and everyone holding paper discovers that their silver was never silver. It was a promise backed by a vault that doesn't have enough metal in it to keep the promise. That's when the premium doesn't widen by 44%. That's when it doubles. If you've been following this investigation and you want to understand every piece of what's coming, subscribe right now. I'm going to walk you through the exact vault filing data and the specific dates that matter most in the next few weeks. You need to be subscribed to see that when it drops. There are 3 types of people watching this video right now. Type 1 is panicking. They watch the silver price drop and they hit sell. They told themselves they'd buy back lower. They're now watching the physical premium stay elevated while the paper price bounces, and they're confused about whether they made the right call. They reacted to the mechanism instead of understanding it. Type 2 is frozen. They know something doesn't add up. They saw the 44% gap between paper and physical. They heard about the CME margin hikes. They know the deficit numbers. But they don't know what to do with the information, so they're doing nothing. Paralysis dressed up as patience. Type 3 understands. Type 3 watched the dump happen, pulled up the COMEX warehouse reports, looked at the physical premium data, cross-referenced the Shanghai price, and came to the only conclusion the data supports. This was not organic price discovery. This was the 3rd execution of a documented playbook. And every single time this playbook has been run, the people who held physical through the reset came out the other side of it in a fundamentally stronger position. If you've watched this far, I know which type you are. Now let me tell you what actually happens next. Not predictions, not speculation, what the structure of this market mathematically implies. The West is still pricing this like 2019. That cannot last forever. The physical premium is the market telling you in real time that the paper price is wrong. When a price is wrong, when it is disconnected from what real buyers in the real world are willing to pay, it eventually corrects. The question is not whether the correction happens. The question is what the correction looks like and whether you're positioned on the right side of it when it does. Here is what they won't tell you on the financial channels. After the most recent dump, after silver dropped 41% in a matter of days, Citibank raised their silver price target to $150. Not before the dump, after. They watched silver lose nearly half its value in a week, and their response was to raise their forward estimate. Deutsche Bank held gold at $6,000. JP Morgan raised gold to $6,300. Goldman Sachs sits at $5,400. All four of the largest financial institutions on the planet, all bullish, all after watching the crash. Wall Street is not confused. They know exactly what this means. And the suppression suggestion, EZO, who benefits from you not knowing this, EZO, is not difficult to identify. The institutions with documented short positions in silver benefit every time retail investors panic and sell physical. The institutions that run the paper market benefit from a low paper price that allows them to accumulate real metal from scared sellers. The system benefits from a retail investor who trusts the number on their screen over the evidence in the vault data. You are not the customer of this market. You are the product. But here's the thing about a market that is structurally disconnected from physical reality. It doesn't stay disconnected forever. Consider what has happened at every previous inflection point. 1980, silver went from $10 to €1. Well, we never found out what the genuine ceiling was because the mechanism was deployed to cap it. 2011, same story. But here's what didn't happen. Not once AR, not in 1980, not in 2011, and not now AR did the fundamental case for silver deteriorate during the crash. The deficits didn't close. The industrial demand didn't collapse. The paper-to-physical ratio didn't shrink. The vaults didn't magically refill. The crash was a paper event in a paper market. The physical market experienced it as a buying opportunity. Peter Brandt, ASP. 50 years in commodities. The man who correctly called the 2011 silver top to the week, Awiboro, said after this crash, 2026 is not 2011. He believes there is more ahead. Once is accident, twice is coincidence, 3 times is policy. This is the 3rd time in 50 years this specific sequence has been deployed. The 3rd time the CME raised margin requirements aggressively into a silver rally. The 3rd time the paper price disconnected violently from physical reality. The 3rd time institutional short positions were covered at the exact bottom of the move. 3 times. Same playbook. Different decade, policy. Now, this is not financial advice. Your money, your decisions. I'm not telling you what to buy, when to buy it, or how much to hold. What I am telling you is what the data shows and what it has shown every time this pattern has run before. If you hold physical silver $8 for real ounces in your hand or in an allocated account with audited vault backing APROS, what you hold is not affected by the paper price in any fundamental sense. The supply deficit is still 820 million ounces. The demand is still growing. The vaults are still draining. The paper that was sold down has no claim on your physical metal. If you hold paper silver AWSI, an ETF, a futures position, a certificate ROSI, I want you to think carefully about what you actually own. You own a promise. That promise is backed by a vault with a 70% inventory decline and 356 other promises per ounce. In calm markets, promises are good enough. In a market where physical delivery demand starts to outrun physical supply, promises become the thing everyone discovers they were holding at exactly the wrong moment. If you're on the sidelines watching Aituraku, this is not the data of a market that has run its course. This is the data of a market in the middle of a structural repricing that is going to take years, not weeks, to fully play out. And if you bought near the top and you're looking at a loss right now, understand that the mechanism that created your loss was not the market discovering that silver is worth less. It was a documented, historically recurring, institutionally coordinated paper reset. The same reset happened in 1980. The same reset happened in 2011. In both cases, the people who held recovered. In both cases, the people who sold at the bottom never got back in. Save this video, come back in 6 months, come back in a year, hold me accountable. Now I want to spend the last 2 minutes of this on something that I think deserves more attention than it's getting. The east-west physical flow is not a trend. It has become a one-way door. China's silver export controls 44 approved companies, covering 60 to 70% of global supply. IDURS went live January 1st. They have not been walked back. They have not been modified. While the paper price was being dumped in the West, those export controls remained in place. The vaults in Shanghai were not contributing their metal to the COMEX settlement pool. The physical that Eastern buyers have been accumulating through 14 consecutive months of central bank gold buying, through sustained physical silver premiums, through the systematic conversion of U.S. Treasury reserves into hard assets euros, that metal is not coming back to the Western paper market. The premium held through the entire dump, in Tokyo, in the Gulf, in the physical dealer networks of the United States. The premium didn't disappear when the paper price dropped. It widened. That is the market telling you in the most direct language available that the paper price is not the real price. Most people will never see these numbers. They will see the red candle on their trading app and conclude that the market has spoken. They will not pull the COMEX warehouse reports. They will not check the Tokyo physical premium. They will not notice that 531 tons of contracts were sold with zero physical movement. They will take the screen price as reality. You've seen the vault data. You've seen the premium data. You've seen the filing data. The screen price and the physical market are telling two completely different stories, and you now know which story the vaults are backing. Send this to one person you know who is looking at their portfolio right now and seeing only red. They deserve to see the full picture before they make a decision they can't undo. Most people will never find these numbers on their own. Share it. That's how information like this spreads past the people who benefit from everyone else not having it. Subscribe to The Hidden Economy. This is what I do. I find the data that doesn't get covered, I trace the money trail, and I show you what it means for every ounce you hold. In the next video, I'm going to show you something that changes the timeline on everything we've discussed today. There is a specific COMEX delivery window, A-Daubios, opening April 28th, A-Euro, where the registered to eligible ratio and the outstanding open interest create a delivery demand that the current registered inventory cannot mathematically satisfy. I've run the numbers. And what they show you is not comfortable. The data is already there, the filings are already public, the date is already set. Drop in the comments. Are you holding or selling? Tell me, the vault is real if this changed how you see what just happened. I read every single comment and I will see you in the next video. The paper said the market spoke, the vault disagrees, and on April 28th we are going to find out which one was right.